Kaspar, when you make a promise, you have to comply with that. So we promise to look forward in the year 2025. So let's get started. There's a lot of things to talk about.
Yeah, we're going to talk about the whole world.
Yeah.
We're going to talk about GDP, inflation, stock markets, commodities, etc. Yeah. And I think we do it a little bit, how do you say, more informal than we used to do, because it's also we have so many sources.
Yeah.
And it's the biggest players in the market, and on a lot of underlyings they say completely opposite things.
Yeah.
So
who are we then to say it's going to be that?
Yeah, but I think that there's something. Yeah, that is. I think that everybody agrees on the fact that it's a challenging year because of the geopolitical problems in the world. Trump, and I'm not going to say I'm for or against Trump, but volatility, because he's unpredictable on a lot of things, and that creates volatility, and that creates directions of underlyings.
Yeah.
You saw this week of Facebook, Mark Zuckerberg, that he in his video message he said, I'm going to also open and more fact check. Yeah. So I think a lot of things will change. So last year was a good year for US investors mainly, especially for IT investors. If you were invested in the France stock market, you didn't have a good year because it was flat. UK grew a little bit, 5-6%.
Yeah, it all
So
depends
not
where you put your
everything.
money.
What I think, so for some investors it was already a challenging year, but I think this year will be a more challenging year. So let's look from a distance.
What the expectations are.
Yeah, exactly.
So when you look at the GDP, it's like how much the economy is growing, of the domestic product of different countries, different areas in the world. Well, what you see in this little picture here is that from Japan, they're expecting quite a lot. At least the GDP will grow in comparison to the United States, where they expect that the GDP will shrink. So the GDP will become smaller. Eurozone, I find it also quite surprising that they think it will grow, but it's only minor, because you go from 0.5 to 0.7 or something. So it's
but it's all positive.
It's positive, yes, but you see the clear decline in the US, which I think is surprising. Emerging markets also slightly up, or you can even say it's been flat now. There's no real.
Yeah, okay, but it is a high growth figure already. More than 4%.
4.5% growth, so that is positive. But yeah.
But it's also in relation to the inflation.
US markets are slowing down. It's what they are expecting. But on the other hand, if you look at the last, for instance, the job openings of December, they were adjusted higher. So you see that there's no reason to think that indeed the economy is already slowing down.
Yeah, but it is all has a lot to do with Trump again, and also the dollar, especially emerging markets. That's really challenging. But hopefully it comes out, and hopefully there is a world growth of GDP.
Yeah, exactly. That's what we're all after. Inflation.
And in the end.
Yeah, inflation. You see that everybody's expecting that it goes down, and I'm not 100% sure about it.
No. In my screen, Martin, I see that emerging markets have also high inflation.
I actually have to rectify what I just said, because I said picked everybody, but it's only picked at asset management. This is a picture of picked at.
No, okay, but it's quite a large player in the market.
Yeah, but maybe they're wrong, and I'm right. I don't think that the prices.
Later on, we're going to show you in a chart, on average, over the last 15 years, I believe, how the market, so the consensus of all the big players, how good or how bad they are with predicting the S&P 500.
Yeah.
So stay tuned. Yeah, I see in my picture that all the inflation figures will go down, and you don't agree with that, Martin.
No, I think it
Why you don't
will
agree
stay
with
flat
it?
now, because already the first signals are that prices are going up. You see that the economies are strong. There's no, I don't see it happening unless they're all planning to decrease the interest rates. It's going to be really difficult. At the end of January, the European Union is going to show the first day, because look at that. It's from 5. It's actually the biggest decline, in 2023, the inflation.
2004.
2023 to 2024, 2024 to 2025. I don't know. I think it will stay more or less flat, because they're at 2.4. This is like an expectation at 2. But we are at 2.4.
Martin, on the other hand, inflation is like the biggest chip in the world. You shift to the left.
It goes really slowly.
And it goes really slowly. So there is a 6 months, 1 year delay.
So that's why I don't think it's going to go that quickly. On the other hand, like you said, the effect of the higher interest rates will take maybe till the half of this year to be really noticed.
Write it down. The market thinks, or Big Ted thinks, that inflation worldwide will go down. Martin thinks it will stay the same at least. No,
More or less the same. Yes.
I hope you're not right. A lot of cases you are.
I am right, and
past,
some cases I've been really, really right. So we'll come back to that a little bit later. Interest rates. Yes, not expect that much. I think we had a couple of years that every time when the Fed came out, at least with some clients, we were very much focused on it because what will the market do? And you see that that end of the year actually Powell was a little bit more dovish, like a little bit more less outspoken about what is going to happen, and maybe that was also to bully Trump a little bit. Maybe you can say that, go against what Trump wants. But the expectations for the US are around 4% now, and in Europe around 2%. So
not too exciting. Well, we are investors.
Yes.
So we want to talk about stocks because you can't invest in an economy. You can invest stock market. And this is an example, and we try to put it in the screen. And if we put it in the screen as we see it, you think, what am I seeing here? Yeah. But this is quite interesting, and that's why we are also a little bit more like informal about this, because what you see in this picture is a lot of the big players in the market, their expectations of the S&P 500 of 2025 diverse a lot. UBS is the quite negative one in this case. So now the S&P 500 is 6,000, around 6,000. UBS expects 6,400. And there are like 3 or 4 players that think that the S&P 100 go up to 7,000. That's Wells Fargo they think in all their wisdom 7,007 points.
Yeah. So
and you have also JP Morgan, Goldman Sachs, and Morgan Stanley, and that's quite on the low side. But this is so if you are a client of Barclays, you receive a yearly outlook in the beginning of January, and they say it will grow with 10% to 6,600. You think okay. And if you are a client with Wells Fargo, you receive the same report. It's
a little bit whatever what the market.
But
the most important thing.
But
all positive. There's nobody that thinks that it's going down. That's true. And then here, this picture is maybe a little bit difficult to understand when you look at it at the first glance. What am I looking at here? So I think the best thing is to look at the most recent moment, 2022. You see that the market and the analysts actually overestimated. They thought the market was going up, in this case about 4%. Market went down around 22%. So you see they overestimated the market performance with 26%. Another big, you see that the overestimations are actually most of the time bigger. So in 2008, they expected the market to rise or to go up a little bit, like 1-2%, and the market went down 50%. So he said they overestimated it with 47%. For this year, they underestimated it. They thought the market was going to go up maybe 3-4%, and the market actually went up 20%. So you see it's a little bit difficult you have to calculate it back, but it's interesting to see that you see that they're not always right.
No,
most of the time actually wrong.
No, that was what I'm saying in the beginning. This is quite interesting, and what you see is, in a lot of cases, they're completely wrong.
Yeah, actually, most of the time, it's never like zero.
Almost 0.4, 1.
The last 5 years.
The last 5 years, 4% they were completely wrong.
10% is wrong.
But
20% wrong. But 26% wrong. 6%.
But on the other hand, they are also like the last 2 years. They were too
cautious.
So it's not always that they are so positive and then the market and the actuals are lower. It is especially the last years, but also except the 2022, the 3 years before, the market did better than the market expected on forehand.
The analysts expected.
Analysts, So I think it's quite interesting. It's quite interesting to see.
I agree with you. Here you see actually an expectation not expectation, this is the actual growth and the start of the year expectations. No? So at this moment, the S&P 500, if you look at the line, the bar that is like that, earnings per share, that is like $275 per share on an average S&P of 6,000, 5,900. So that's 22 times the earnings. And then the actuals, you will see it's quite a big increase, because last year the actual of 2024 was I'm sorry if looking at the screen, to 30. So they expect it to go up almost 17%, which is also dangerous, because if they don't commit to that, then you see what happens to companies that we talked about, Adobe. When they don't comply with the expectations, bam, they get punished really badly.
Yeah, even Nvidia. But on the other hand, when you see the S&P 500 and a lot of stock markets went up for the last 15 years, and a lot of people say, yeah, but it only goes up. Yeah, but the underlying companies are also performing better. They
grow, they become bigger.
You see it in this chart. The earnings per share of the S&P 500 is going up and up and up and up and up. So there is a fundamental driver for the stock market so far to go up.
I totally agree.
But on the other hand, is it overvaluated, undervaluated? That's the question, and that's where we try to talk about, and the whole market try to create an opinion on.
Yeah, this chart shows you the price earnings over the past 10 years. So you have the solid line, to say it like that. The blue line is the forward 12-month price earnings. So at this moment you can see that we're at 22 times the earnings. And that you can see was also the scenario in 2021. After the COVID bull run, everybody went into stocks. You saw a big decline in 2020, and then all of a sudden price earnings around 22. 2021, the market was also still decent, good, and then we had 2022, and at the end of 2022 I had a seminar here with somebody else in the office, and I actually warned people, but in a positive sense, that hey, stocks have been punished really badly. It might be a good moment, because the price earnings at that moment were around 14.50. At this moment,
what do you think now, Martin?
Well, if you want to follow my track record and looking at this chart, I would say, be careful, because you saw it also in previous moments. It's a pity that you can't see here 2000 and 2008. If you would make this chart even wider, you can see that we're at the same levels as in 2008, as in 2000, after the dot-com bubble, after the big subprime crisis, before the subprime crisis. So it might be one of these signals to be a little bit more cautious, because we are all, I think, a little bit spoiled with 22% on an annual basis on your investment portfolio.
But on the other hand, if you are an entrepreneur and you bought a company in the past, and you maybe paid 6 times the profit, 8 times the profit, 10 times the profit, and those people always, if they realize how the stock market works, they say, this is too expensive. But what you see in this chart, you see you have 2 dips here. That is like 13 and 14. But you can say that...
This is 18, You're looking at 2018.
Okay. But if you the 2 dips, if you take the 2 dips out, then it's the lowest earnings per share for S&P 500, 15. Yeah. So the market, and if you agree it or not, but the market always... valuates companies on the stock market quite high. So the bottom line is 15.
No, but the average is 18. Over the past 10 years, the average is 18. The 5-year average is now, at this moment, 19. So you see already that things are changing compared to before.
Yeah, and what we also talked about a couple of weeks ago about the S&P 500 underlying sectors, that you see that there are some sectors because this is an average of the S&P, of the 500 stocks, so also an average of the different sectors. And you see a lot of huge differences between the sectors, but because I don't remember exactly, but I think that the real estate sector was
36 something.
36 PE, so they push it on the high side. And that's also in the next slides, we're going to see what the market thinks about the individual sectors of the S&P 500 on the margin growth level.
How they will grow and how much. And then you see, of course, here again, the biggest growth is expected in the IT. And the funny thing is what you just said. In the real estate, you see that they expect that the margins will shrink, that it will go down, that it will become smaller.
And that's also really 36% PE on the real estate.
So it's logical that a little bit goes up.
And everybody thinks, but still high. So I think there's a lot of people that will go short in it.
Quite well possible. Doesn't look like it when you go outside the office here. The amount of building that's going on.
Yeah, but those companies are not in S&P 500.
They're not in S&P. No, they're on the index though. It would be funny to see how the Spanish real estate sector. We should do a session about it again. I think to have a look at it, because you see that the promoters, how much money they're making, and it's insane.
Yeah.
Productivity, difficult slide to look at. I think we're going to skip it for now.
Productivity is higher.
It's much higher. You see the average turnover per worker has increased a lot, so that's in that sense positive compared to 2000. Gold.
Yeah, we spoke about commodities in last year, and also in when we look back on the year. And the best commodity there was cacao. I don't remember the percentage was, and I think gold was number 2. I think if you look at all the reports, there's a lot of attention for gold.
Yes.
And gold is, and then people say, okay, but gold is almost the highest moment ever. Yeah, okay, but in the video also had moments in the Bitcoin also, and that it can go up. So that's not an argument. Yeah? No. And of course, you had bought it like 2 years ago. It's also not an argument. It's going the outlook. And if you look what happened for the last 2 years, that explains why gold went up.
Yeah, you can see here in the period before 2020, 4 years before, that mainly Turkey was the government that was buying the most amount of gold. So the export of gold was going for big chunks to Turkey. Also Dubai, the United Emirates were buying quite a lot specifically. But one country that comes back also a lot is Hong Kong, specifically the last 3-4 years. You see China, of course, buying a lot. Also India, is mainly in 2023, was very active on the gold market. So that huge amount of, you see that central banks have been purchasing big amounts of gold.
And that explains that gold went up.
Yeah.
The question is, will they continue with buying, or do they have enough already? I don't know. Maybe you know.
No, I don't know. I wouldn't even know what they want to do with it. I mean, I can make my ideas about it, but why is it? It's funny, right? It's specific areas. You see, there's no European country really in this. Yeah, so Turkey you could consider maybe about half, but Europe has not been buying as much gold. If you look at this chart.
Geopolitical inflation.
Yeah.
I think it's a hard asset, and I think it has quite some interesting. It is some interesting outlook. What I said in a lot of outlook reports, you see gold is an important part, and on average, it is expected that it will grow further.
Yeah, true. Yeah, so the gold price it will rise possibly to what it say here on the slide that we see in front of us. $3,000. That's what Adrian Ash of the Bullion Vault is
thinks about his own product.
Yeah, I think that's indeed what you're saying. He's talking in his own street. Right?
But I think a conclusion that the market is quite positive over the most important indicators. So inflation goes down, interest rates go down. GDP will go up. Stock markets, and we focus this time on the S&P 500, will go up. On the other hand, what you also saw in one of the slides is that the market, the expectations, even with the big players, it is a big difference. It's not a big difference because they all expect growth. 6 point from 10% or 8% to 12%. So there's also, but they expect that. But what will happen, that you never know. And I think it will be a challenging. It won't be a market that you think you can buy on the 2nd of January and on the 31st of December. Okay, let's see how we did it. I think you have to be more focused, a little bit more alert, and a bit more active than the last years. What do you think, Martin?
No, I agree with you.
Let's see at the end of the year if Martin was right, if the inflation went up again, or that
I have to do something if I'm wrong, right? Anyways, thank you for watching, and I'm hopeful to see you again next week.
And if you have your comments, and if you we have quite some sources. So if you say, okay, what do you think, or what is the estimations on this commodity, or on this market, or on this currency, let us know, and we can share what we have. So for now, thank you for watching. Give us your thumb.